So, what if I told you that a town's real estate market just exploded by like almost $1 million in median value in a single year?
I mean, I'd say that sounds like a pretty massive boom.
Right. But the catch is nobody living there actually got any richer.
Hmm.
And the market was technically slowing down at the exact same time.
Which is such a crazy paradox when you just look at the surface level numbers.
Exactly, because usually when you look at a price tag on a house, you expect this absolute transparency.
Right, yeah. You see the sticker price, you do the math on your mortgage, and you basically know what it costs to own the thing.
But if you step into the real estate market of the last few years, that simple price tag becomes a total illusion. You're really only seeing the very tip of the financial
Oh,
iceberg.
absolutely. The hidden costs are wild right now.
So today, we're taking a deep dive into a highly specific and honestly fascinating real estate report. We're looking at the June 2026 Mammoth Lakes real estate market update.
Which is such a fantastic lens to look through, by the way.
Yeah, why Mammoth Lakes specifically?
Well, mountain towns like Mammoth often act as these hyper-concentrated microeconomies.
Right, because they're geographically constrained.
Exactly. They are constrained and highly desirable, so they show us shifts in buyer behavior and overall market health much more vividly than like broad national data ever could.
That makes total sense. So the central theme of today's exploration is really the anatomy of a maturing, balanced market.
A maturing market, yeah.
We want to explain this theme by looking at what actually happens when a previously chaotic, highly appreciated market finally normalizes.
Because national headlines are still screaming about extremes.
Totally. They're all about the impending crash or the next big boom. But this hyperlocal data reveals some incredibly sneaky traps.
Traps that can cost you a lot of money if you aren't paying attention.
We're going to show you how a single statistic can completely lie to you and why the actual sticker price of a property is no longer the most important number for you to look at. Okay, let's unpack this.
To really understand what's happening on the ground with these specific properties, we first have to look at the fuel driving the entire machine.
And by fuel, you mean the money, right?
Right. Specifically, interest rates and the overall buyer psychology right now in 2026.
Because before you even start scrolling through listings and, looking at kitchens, you have to look at the loan.
Exactly. You can't ignore the borrowing costs.
I know the report gives us a very clear snapshot of where those costs are sitting, but break down what we're actually looking at here.
Well, as of June 3, 2026, the prevailing rate for a 30-year fixed mortgage is sitting at 6.61%.
Okay, 6.61.
Yeah. And if we look at jumbo loans, those are hovering just slightly higher at 6.7%.
Wait, let's pause on that term for a second. Because I think a lot of people hear jumbo loan and picture like a mega mansion with a bowling alley.
Right, yeah, that's a huge misconception.
For anyone who hasn't encountered one, a jumbo loan is really just a mortgage that exceeds the standard financing limits set by the federal government.
Yep. It just means a larger than average loan amount.
So in expensive markets like California mountain towns, you might need a jumbo loan just to buy a standard three-bedroom family home, right? Because local prices outpace those federal limits.
That distinction is crucial. And the fact that jumbo rates are at 6.7%.
Which is incredibly close to the standard 6.61% rate.
Exactly. It tells us something vital about the banking sector. It shows lenders are pricing risk relatively smoothly across the board right now.
Oh, I see. They aren't terrified of this market anymore.
Right. If we connect this to the bigger picture, that mid 6% range represents something we haven't seen in a while, which is stabilization.
The psychological shift there is fascinating,
Yeah.
honestly, because the narrative for the last few years was defined by wild, volatile rate hike cycles.
It was a roller coaster.
Buyers were operating in a constant state of panic. It felt like borrowing costs were just a moving target every single week.
Now, that stabilization at the end of 2025 and into 2026 has fundamentally altered how buyers behave. Affordability has actually improved.
Wait, really? Because prices haven't exactly crashed?
No, not because homes suddenly became dirt cheap, but because the cost of borrowing stopped spiking every other Tuesday. Buyers can actually plan now.
The analogy that comes to mind isn't really about speed, it's about clarity. Like, we've gone from flooring the accelerator to finally setting the cruise control.
I like that. Cruise control.
For years, the market felt like a snow globe being violently shaken. Rapid appreciation, waived inspections, panic buying, just a blizzard of chaos. You couldn't see the landscape.
You really couldn't. It was just a blur of offers.
But now, we finally set the snow globe down. The snow is settling. We can actually see the terrain. And prices in Mammoth Lakes are largely flattening out,
Right. They aren't in a free fall, but they aren't rocketing upward either.
which is a good thing, right?
It's a great thing. It's a classic sign of market health, not market weakness.
But people don't always see it that way.
No, there's this pervasive misconception that if prices aren't climbing by 20% a year, the sky is falling. But flattening prices after years of rapid appreciation is exactly what a maturing market is supposed to do.
So the panic is basically gone.
Basically, yeah. Sellers aren't highly leveraged and desperate to offload, and buyers aren't frantic. The word the report actually uses is intentional.
Intentional. I like that. So if buyers have the luxury of time and they're being intentional, we have to look at where they are actually putting their money.
And the report points to condos as the most active segment of the Mammoth Lakes market.
But here is where I have to push back a little bit, because I'm reading the underlying data here about hidden variables that are severely complicating these condo purchases.
Ah, yeah, the hidden variables.
If condos are this absolute minefield of exploding fees and complications, why are they still the highest volume segment? Like, why haven't buyers completely abandoned them?
You're touching on a phenomenal contradiction there. Buyers haven't abandoned them because, well, mathematically, condos remain the most accessible entry point into the mountain lifestyle.
Even with the issues.
Even with the issues. They offer the amenities and the location that buyers want, but at a lower initial price point than a single-family home.
Okay, let's look at the baseline numbers for condos then.
Sure. So the condo market is moving at a solid clip. We're seeing about 18 sales per month in 2026.
Which, looking at the data, is a slight dip from the 19 per month we saw in 2025, but still a very active pace.
Definitely. And the median sale price for a condo through May is $783,500.
Okay.
It's actually a bit lower than the $829,000 we saw during the same period in 2025. Though year to date, the momentum is ticking upward from April's $739,000.
Got it. And what about the median price per square foot?
That's sitting at $660, and homes are only sitting on the market for 61 days on average, down from 71 days in 2025.
So on paper, those numbers paint a picture of a very smooth, predictable market.
Yeah.
2 months on the market, then a sale.
On paper, yes.
But let's get into the weeds on why the sticker price is an illusion here. The catch is the operating costs, isn't it?
Huge catch. Increasing homeowner association dues, HOAs, and special assessments are no longer the exception. They are the absolute norm for these mountain complexes right now.
We really need to explain the mechanism here for you guys listening, because as a buyer, you look at a $783,000 condo, you calculate your 6.61% mortgage, and you think you have a locked-in monthly payment.
But you don't. Not even close.
Exactly. The report highlights that skyrocketing insurance premiums are totally rewriting the math for these buildings. Why is insurance suddenly the villain in this story?
Well, it comes down to how insurance companies are assessing risk in 2026. Following years of massive wildfire payouts across California, insurance carriers have just adopted zero-tolerance policies.
Zero tolerance. Wow.
Yeah, they are literally flying drones over these condo complexes to inspect the roofs and the siding from the air.
No way. Drones.
Drones. And if they see deferred maintenance, like an old roof or aging wood siding, they simply threaten to drop the policy entirely.
Wait, and if an HOA loses its master insurance policy, no bank is going to issue a mortgage for any unit in that entire building. Right?
Precisely. The whole complex essentially becomes unsellable overnight.
That is terrifying.
It is. So to prevent that, these older complexes are being forced to undertake massive capital improvements immediately. New roofs, fire-resistant siding, exterior upgrades, you name it.
And someone has to pay for that.
Right. To pay for those multi-million-dollar projects, the associations are dramatically hiking their monthly dues just to keep the lights on and the policies active.
And it doesn't stop at just raising the monthly dues.
No, then they turn around and hit the owners with special assessments. We're talking tens of thousands of dollars just to bridge the gap for the construction costs.
Man. For those who haven't sat on an HOA board, a crucial document mentioned in this context is the reserve study.
Yes, the reserve study is everything right now.
It's basically the building's financial physical. It tells the association exactly how much cash they need in the bank to replace major components over the next 30 years.
And what we are seeing is that many of these older buildings have historically underfunded their reserves. They just kept monthly dues artificially low to keep people happy.
And now the insurance mandates are calling their bluff.
Exactly. The savviest buyers in this market are demanding to see that reserve study before they even look at the kitchen countertops.
So the actual cost of ownership has entirely decoupled from the list price. Are buyers even looking at the list price anymore, or are they essentially just shopping for the least terrifying HOA financials?
That is exactly what's happening. The sticker price is an illusion if the operating costs aren't factored in. Success in this segment requires early preparation.
Because if you buy a condo that's priced $50,000 below market value, but the HOA has an underfunded reserve and is about to drop a $70,000 special assessment on you for a new roof.
You didn't get a deal. You bought a huge liability.
Right. Let's follow the buyer's logic then. If you're a buyer and you discover the condo market is this complex web of insurance mandates and hidden assessments, you might naturally pivot.
You'd think, let's just look at single-family homes.
Yeah, you might think, I'll just buy a house, give me my own dirt, my own roof, and no shared walls. But when we look at how the single-family homes are performing in this report, the data throws a complete curveball.
The single-family data is a perfect case study in why you can never just read the headline numbers and assume you understand the market mechanics.
Okay, so let's look at the numbers. Single-family homes are barely moving compared to condos. We are talking about approximately 5 closed sales per month.
Which is completely flat compared to this period in 2025.
Yeah. The total volume is incredibly low, just 24 closed sales year to date.
And those homes are sitting on the market significantly longer. The days on market jumped to 110 days for closed sales.
Wow, up from 87 days the year prior. And active inventory is just sitting at 24 listings.
Right, it's moving very slowly.
So we have incredibly low sales volume, and houses are sitting on the market for almost 4 months. The logical assumption, based on basic supply and demand, is that prices should be dropping.
You'd think sellers would be slashing prices to attract the few buyers out there.
But the median sale price for a single-family home in May skyrocketed to $2,260,000.
And for context, in 2025, that median price was only $1,300,000.
Here's where it gets really interesting. It looks like the market exploded upward by almost $1 million in median value while nobody was buying.
It really does look like that.
This is the paradox I mentioned at the very beginning of the show, and it perfectly illustrates the billionaire in the diner math problem.
Oh, break that down for us. I love that analogy.
So imagine you're sitting in a small roadside diner. There are 10 regular people in there, maybe making $50,000 a year. The average wealth in that room is pretty modest.
Makes sense.
Then a billionaire walks through the door and orders a coffee. Suddenly, the mathematical average net worth of every single person in that diner skyrockets to over $90 million.
Right, but nobody in that room actually got any richer.
Exactly. Their lives didn't change at all. The data was just severely skewed by one massive outlier.
And that is exactly the danger of relying on median prices in a low-volume market. It's a total illusion driven by a highly concentrated cluster of luxury sales.
So the overall market didn't actually double in value.
Not at all, because the total volume of single-family homes is so incredibly small. Just 24 sales all year. Any high-end purchase is going to violently drag the median upward.
Oh, I see.
In this case, the report notes there were 6 sales over $3 million in 2026.
So just 6 luxury sales single-handedly drag a $1.3 million median up to $2.26 million.
Yep. When 25% of your total sales volume is ultra-luxury, the median becomes mathematically factual, but practically useless for the average person.
So if you own a modest $1 million cabin in Mammoth, your home didn't suddenly double in value. Your equity didn't change.
No, it didn't. And if you are a buyer reading a headline that says, Mammoth Lakes single-family home surge past $2 million, you might completely give up.
You'd think you've been priced out of the entire zip code.
Right. But the reality is that the strongest demand is actually happening below that luxury tier. The data tells us properties overall are generally selling 3 to 5% below list price.
So the market is stable, buyers are negotiating, but the math being reported in the headlines is utterly distorted.
It really highlights why critical thinking is essential when trying to make sense of localized data. Adages and medians require context. You always have to look at the denominator.
The denominator being how many total sales actually make up that number.
Exactly.
So if the condo market is secretly defined by hidden insurance costs, and the single-family market is being mathematically distorted by a few mega mansions, Who actually holds the cards right now?
Who has the leverage?
Yeah, if you're out there trying to negotiate a deal, who has the power? To figure that out, we have to look past the prices entirely. We have to look at a metric called month supply.
Which is such a critical metric.
If you are house hunting anywhere right now, in any city or state, this metric is your secret decoder ring. Month supply is a measure of market velocity.
It calculates how long it would take to sell every single active listing on the market right now, assuming no new homes get listed, based on the current pace of sales.
So it's the ultimate indicator of leverage. What's the rule of thumb for reading this?
Well, the rule of thumb is pretty standard across the industry. 0 to 4 months of supply is a seller's market. Inventory is tight, buyers are competing, and sellers can hold firm on their prices.
Okay, what about a balanced market?
5 to 6 months of supply is considered balanced. Neither side really has a distinct advantage. And anything 7 months or higher shifts into a buyer's market where inventory is piling up and buyers can demand concessions.
Okay, so looking at the total market overview for Mammoth Lakes, condos are sitting at exactly 5 months of supply.
Perfectly balanced.
And single-family homes are at 4 months, which gives a very slight advantage to the seller. But, as we just learned with the billionaire and the diner, looking at the broad overview hides the real story, doesn't it?
It absolutely does. When you break this down into micromarkets based on price point, the data is wild. What's fascinating here is how fragmented the market has become.
Fragmented how?
Well, you can have a fierce seller's market and a stagnant buyer's market happening on the exact same street, separated only by the asking price.
Listen to how polarized these micromarkets are, guys. If you are looking for a condo under $500,000, there is an 8-month supply. That is a solid buyer's market.
Right. Lots of options for buyers there.
But if you are looking at luxury condos, $2 million and up, there's a 12-month supply. A full year's worth of inventory just sitting there waiting for a buyer.
Then look at the contrast in single-family homes.
Yeah, if you want a single-family home under $1 million, there was only a 1-month supply.
Just 1 month.
Even homes between $1 million and $1.5 million only have a 2-month supply. It really forces me to ask, is a balanced market just a myth?
That's a great question.
Because depending on your specific price point, it sounds like you aren't in a balanced market at all. You're either locked in a brutal dogfight for an entry-level house, or you are wandering through a ghost town of unsold luxury properties.
That's a brilliant observation. A balanced market on a macro level often just means the extreme highs and extreme lows are mathematically canceling each other out.
Oh, wow. So they just average out to look normal.
Exactly. The reality on the ground is that the gap between standout properties and the rest of the pack is widening dramatically.
So what actually makes a property a standout in a stabilizing market like this?
Realism. Sellers who price appropriately for current interest rates and who present their properties flawlessly are the ones moving that 1-month supply. The report emphasizes this point heavily.
It says aspirational pricing is a dead strategy, right?
Totally dead. Aspirational pricing being the seller who says, well, my neighbor got $1 million 2 years ago when rates were at 3%, so I want $1.2 million today.
Oh, yeah. Those are the properties sitting on the market for 110 days or more.
The market heavily rewards preparation and punishes delusion right now. Because buyers are intentional, and because they aren't panicked about interest rates spiking tomorrow, they will gladly walk away from an overpriced listing.
They know they can just go look at the other 12 months of supply in the upper tier brackets.
Exactly. They have options.
So what does this all mean for you, the listener? Even if you have absolutely no intention of ever buying a ski condo or a mountain cabin in California, this deep dive is a masterclass in how to read data and approach major negotiations.
It really teaches you to question the surface-level metrics that drive the headlines.
The 2026 market proves that relying on high-level averages, like a distorted median price, or a generalized overview of supply, will completely lead you astray.
It will. Success in any major purchase right now is no longer about blindly trying to time the market perfectly.
It's about understanding the mechanics. It's about discovering the true hidden costs of ownership, like how a changing insurance landscape can turn an affordable HOA into a financial nightmare.
You have to know the specific micromarket you are actually standing in.
And this raises a really provocative philosophical question, doesn't it? Something to mull over.
It does, and I think it's something everyone should consider as we look toward the future of real estate everywhere, not just in mountain towns.
What's the question?
Well, we are seeing strict environmental realities and skyrocketing insurance premiums, forcing massive, unavoidable maintenance bills onto current owners just to keep their buildings insurable.
Right, you literally have to replace perfectly good siding just to keep the policy active.
So, if these recurring operating costs are fundamentally reshaping who can even afford to maintain a property, are we entering an era where the ongoing upkeep of a home dictates local real estate markets more than the actual value of the land itself?
Wow, that completely flips the traditional script of real estate. Location, location, location becomes maintenance, maintenance, maintenance.
Right. If the annual cost to insure and maintain the structure sitting on the dirt eclipses the value of the dirt itself, the entire concept of property value has to shift.
The price tag on the house becomes secondary to the mandatory subscription cost of keeping it standing.
Exactly. It's a paradigm shift.
It brings us right back to where we started. That clean, transparent sticker price you thought you were looking at, it really is just the tip of the iceberg.
You really have to be willing to look at the mechanics of what is operating underwater.
You really do. Well, thank you so much for joining us on this deep dive. Until next time, keep looking past the headlines.